Hello folks, Brandon Chapman coming to you from TheoTRADE. It's the Monday video for August 25th, 2025. And boy, as we look at the S&P 500, if you were looking on Friday, you saw a nice update for the broader market. The S&P was up nearly 1.5, 1.6%. The VIX, well, the VIX got smashed. It got smashed back below the prior low on August 13th, below the prior low back on July 31st. We're trading at the lowest level we've seen since really you'd have to go back to December 24th. What does this really tell us about the market and the potential for a near-term rally in the market? Or is this flashing a major warning sign that we probably need to take heed of or notice of? Here's the thing. When the VIX goes down and the market has a big day like it did, the reason why the VIX is declining is they're selling volatility. Right? And the VIX, when the VIX goes down, we know the market's up, and especially on a day when the VIX is down as much as it was on Friday. And we can suddenly become very encouraged by what we saw on Friday. But however, when we look at this, gold was also stronger on Friday. Gold was up 1%, the S&P was up 1.5%. And what was the major driver for the S&P 500? At the end of the day, it was a weaker dollar. Powell's statement at Jackson Hole suggested that, we now need to consider the labor force, not just inflation, and we got to balance this out. He discussed the fact that the jobs market is actually weaker than what they had seen previously, and what the ultimately says, if the jobs market's starting to turn, you're in recession. So the fact of the matter is the strength in the market was all about dollar weakness, all about the Fed potentially cutting rates. And guess what? Treasuries were also higher on Friday. Certainly not this inflationary posture, right? If we're talking about the Fed cutting rates leading to significant inflation down the road, we probably should have seen more of a significant sell-off in Treasury bonds. But we didn't. The reality is bonds were bid. The dollar was sold. Everything denominated in dollars rose on Friday. But what we saw was that the VIX was declining. But did you know that the VIX represents future expectations of volatility? The problem is, and I've realized this about 20 years ago, back in 2005, that the VIX itself, by itself, is useless. If the VIX goes down, the market's going up. If the VIX is going up, the market's going down. What does that really tell us? At the end of the day, the VIX is only valuable at extreme. Is 14 the extreme this time? Or if we notice back in December, the extreme was 12.8. At other points, it's 10. At other points, it's 9. 10 was considered a 0 before we hit 9. Now 9's considered a 0 VIX. The problem is that the VIX peaks and troughs at different levels all the time. As a result, I use a different indicator. What I'm concerned about is front to back month volatility, or rather back to front month volatility. What we're seeing today is that the 3-month VIX is 22% higher than the 30-day VIX. And on Friday, we were at 25% higher. Again, what that's forecasting is saying, yes, the VIX was smashed on Friday, but 3-month volatility remained elevated. And what we saw with the decline in the VIX was that suddenly the market is expecting much higher levels of volatility in the next 30 days. Now look at this. We triggered on the 23rd of July. We triggered on the 8th of August, and we triggered again. On the 12th of August, and again on Friday. We've had 4 major signals in the last little over a month. If we've looked at the S&P 500 since we received that initial signal back on the 23rd, it hasn't been exactly a one-way street to the upside. When I see that signal coupled with skew remaining elevated, which we've been in this position since the 23rd, the 23rd skew index was a 160. We're seeing a high degree of hedging activity. We're seeing high volatility expectations. And as we look at the market, have we seen volatility expand since the 23rd? You bet. This decline from peak to trough was 3.5%. The decline from peak to trough here was nearly 2.5%. Not exactly the 5 to 10% correction that I expect based on that signal on the 23rd in the next 30 days. We just barely crossed out of that volatility zone on Friday on the 22nd. But guess what? We got a brand new signal, the same signal that triggered back on the 8th and again on the 12th here. There's the 12th right there. We know that it is going to be tough slogging for the market. We might have big days like here or back on the 12th or back on the 23rd. But the reality is all we're doing is resetting the clock to the downside of the market to the tune of 5 to 10%. A 10% correction from present levels might carry us back to the 38% retracement of the uptrend from down here April to the high here in August, which we tested on Friday. Yes, you could say RSP, look, well, equal weight broke out to new high, but it's been languishing for longer. The 23rd, that's right there. In fact, that was or close to the peak right there, the 23rd, up until Friday. We did see a rush to do what? We saw a rush to close shorts, right? We had a big time short squeeze on Friday. But the point is, this is not a lasting move. We need something more fundamental to carry the market to further extremes. If you start to add together multiple valuation ratios, PE, 4PQ rate, all this other stuff, we might argue that the S&P has never been more highly overvalued since we were on Friday's close. Now, again, valuation is not great for timing, but what we're seeing here in the options market reflected in the VIX, the 3-month VIX and skew, we're seeing high volatility expectations and significant hedging. So based on that, what are you going to do about it? The fact of the matter is, this signal is fairly significant. You don't get it this often. Sometimes you get it multiple times, but it generally follows through with some sort of significant correction in the market. We crossed above here back on the 29th of November. Crossed back above here. Well, guess what? We had a sell-off. We crossed back above on the 24th. We had a 5% sell-off. We crossed back above on Valentine's Day. We had more than a 5 to 10% correction in the market. We've been flirting this going back for a number of weeks. We're finally starting to see us really plant ourselves up here. And what this tells you is institutions are pricing in significant volatility around the corner and at a time over the next 3 weeks where we have the most bearish period in the market. The most bullish coming out of the July 4th holiday. The most bearish started here about 2 weeks ago and is going to extend through the middle of September. So the point is, you take large bets to the downside. Do you risk it all in lieu of a major market move? Probably not. I've certainly have not. That's not something I pursue. But is it time to take profits? Absolutely. Is it time to look to hedge your equity exposure? Absolutely. In fact, I walked through how to hedge a portfolio of S&P 500 correlated stocks multiple times over the last few weeks. I showed our members how to buy puts and sell call spreads and manage the hedge and when to roll and take profits out of the trade. What I'm going to show you right now is based upon the VIX. This might be considered a trade or a supplemental hedge. Well, what does this mean? The VIX. Well, the VIX, these are cash settled options. What this means is there's no risk in holding through expiration. And we're trying to go out about 30 days. I usually like to stick with the monthlies, but the next monthly after 22 days is 85. I'm not prepared to go out that far. I'm looking the next 30, the 24 SEP expiration, centered on that same time frame that the VIX is looking at. And what we're trying to do is structure something. Now, with the VIX at around 14-ish, now raising to 14.8, this is something I showed earlier today in my session, the main chat room on TheoTRADE. It's a trade that we also took in my Ghost Prince, with my Ghost Prince members. We took a 19 and sold a 24. I try to structure 5-point spreads. 24. I try to structure 5-point spreads around 20. In this case, we can go to 19. It costs 67 cents. Okay, so that's not a bad pricing. You're paying 67 for the prospect of selling the spread for $5 and walking away with $4.33 gain, or $433 per contract. But that's a little bit pie in the sky. One thing we know about the VIX, we can pop and drop quickly. Holding to expiration is not generally a viable strategy, unless we get the sell off late. What can you look for? Well, immediately, if we're buying this for 67 cents, the intent would be to sell it for 220. Create an opposite order here. If we can get this for 220, we're getting basically near a 250% gain. It's a little bit less than that going GTC. If we get a spike, guess what? You might be able to capture that. Another alternative would be if we get a big move in the VIX. This would be if you had more than one contract, you could try to sell at this point. And I'm going to load a study set here. It's just a Keltner channel, 2 ATR 20 days. And you'll notice back here, we got this signal on the 1st of August. If this crosses above the upper Keltner, which right now is around 19, if we were to pop up here to 20, you might consider closing part of your VIX position if we get that trigger. A more significant signal that's more corresponding with a 5 to 10% correction, and there's the bell, folks. We're looking at the 3-month to 1-month VIX ratio. If this can get down here below 1, meaning what? Meaning that the 3-month VIX drops below the 30-day VIX. If we see that, that's the sign to close out the rest of your VIX spread. So we've got 3 potential exits. 220, the VIX popping above the 2 ATR 20-day Keltner channel, or the third being we end up trading down here below 1 on the 3-month to 1-month VIX ratio, meaning what? The longer dated 3-month VIX dropping below the 30-day VIX. We're expecting lower volatility in the near future. So while you may not want to bet the farm on a big downside move, this is a very appropriate time to consider hedging. And again, hedging an equity portfolio, I'll teach you about it here at TheoTRADE. Again, we have an entire strategy around this called the Atomic Hedge. But here is a supplemental hedge or a trade. Now, if you're doing this for a hedge, you might shoot for about 60 to 70% of the spread width. That means 3 to 350. But as a trade, we're going to clip it a little bit early, around 200 to 250% gain. That's at 220. But this is a trade that's pricing well right now, given where the VIX stands. And again, we're expecting to see a decent move in the VIX over the next 30 days. And again, we're expecting to see more volatility in the equity markets. Well, folks, that's all I got for you today. We'll catch you back next week on the video. You have a great one. Thank you.